Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is twofold. According to the curriculum 2016, its code is MS251, and according to the 2018 curriculum, its code with the same course outline and content is BS 251. This is our lecture number 17, and the topic for discussion under this lecture is bond price and yield relationship. Here yield means the required rate of return in the market and its nexus with the bond prices. So let's discuss this topic. The outline of this lecture consists of the three main agenda points. The discussion will start with the relationship between the bond price and yield. Let me explain you that another name for required rate of return in the case under discussion is the yield. So when I am talking about the yield and bond price nexus or relationship, it means that I am looking to discuss the relationship between bond price and the market required rate of return. Secondly, the discussion will continue on with the discussion of role of bond maturity on bond prices. Like for example, if the maturity of a particular bond is 5 years and with a similar nature, same risky bond, second bond having the maturity of 15 years. So what is the impact of such bond maturity on the bond prices? Last but not the least, the discussion will conclude in this lecture with the topic of the role of bond coupon rate on bond prices. Basically, I strongly urge the student and listener of this lecture to go through from my 4 previous lectures on the valuation of different bond and common stock securities valuation, because this lecture is in continuity to my previous lectures and certain jargons and terms used in these lectures have already been explained in my previous lectures. Let us discuss the first topic. Before explaining the nexus between the bond price and yield or relationship between the two terms, we need to understand certain phenomena before discussing such relationship. What is a bond? Bond is a contractual obligation between two parties that requires the issuer of bond to give the particular fixed interest rate to the holder or purchaser of the bond. Bonds can either be sold under 3 circumstances. One is known as the discount bond. The second one is known as the premium bond. The last one is known as the par bond. I'll start from the last one, which is par bond, because this is the starting point. The par bond means that the coupon rate equals the market required rate of return. Such kind of bond issuance is known as the par bond. Let me give you another example. The par bond is the one which is selling in the market on the specified face value. We have already explained the peculiarities and characteristics of the bond securities. So therefore, I assume that you know very well what is the coupon rate and what is face value, maturity time period, issuer and holder of the bond. If you have any confusion, you can go back to my previous lecture on security valuation and you will have enough discussion on such terms. Anyhow, the par bond is the one which is selling in the market on the stated or specified face value. Let me select the pen. Let's suppose if the face value of a coupon paying bond is $1,000 and it is selling into the market on the same price, which is $1,000. So we can say that when such kind of bond is selling in the market on face value, this bond is named as par bond. The second definition for par bond is the coupon rate, which is the stated interest rate mentioned on this security when it is equals to the market required rate of return. Then we can say that this bond is selling at par value. Now, what is market required rate of return? Market required rate of return is the investor's expected required rate of return while they are looking to invest in any particular security by keeping into consideration the factors like inflation, the opportunity cost, and the competitive market rates, along with that the risk-free rate into the market. So bearing all these factors into consideration, the investor normally required certain rate of return from a particular risky investment, and that expected rate of return is known as the market required rate of return by the investors while looking to invest their precious money in. So when the coupon rate, which is the stated interest rate, equals to the market required rate of return, let's suppose, then we can say that this bond is selling at par value. Similarly, let's come towards the discount bond. What is known as a discount bond? If the face value of this bond is $1,000 and into the market, if this bond is selling at a price less than its face value, like for example $900, so in this case we can say that this bond is selling at discount price, or we can simply say it's a discount bond. Looking into another perspective, when the market required rate of return, which I have explained for instant before, when the market required rate of return by the investor exceeds the stated coupon rate on the bond, like we can say that the par value is greater than the PI, it means that the bond is going to sell out at discount price. Here in bracket we can see that the par value of such bond, which is normally $1,000 in United States, will be greater than the market price of this bond. This PI is the current prevailing market price of this bond. So when the par value is greater than the market price, like in this case, the par value or face value of this bond is $1,000. However, its market price, which is P0, is $900. So in this case, such kind of bond is known as a discount bond. Now let's come towards the premium bond. What is a premium bond? With the same face value, let's suppose, which is $1,000, if the bond is selling out at a price excess to its par value, let's suppose at a price of $1,100, so in this case we can say that this bond is selling at premium price. Looking into another side or another way around, we can also define premium bond in a fashion that if the coupon rate on such bond, which is the stated interest rate, when it exceeds the market required rate of return, in that case the bond is known as selling at premium price, or it is simply known as premium bond. Into the bracket, we can see that the such bonds market price, which is the P naught, the current market price, is exceeding the par value, which is the face value of this bond. So this is the basic difference between a discount bond, premium bond, and a par bond. Now let me summarize it quickly. If the market price of the bond is exactly equal to the par value, it is known as par bond. When the market price of a bond is exceeding the face value of the bond, it is known as premium bond. And when the par value, which is the face value of the bond, is greater than the market price, it is known as a discount bond. Let us explain the nexus between the bond prices and yield relationship. On y-axis, we have the bond price, as we would like to develop the relationship between these two factors. And on horizontal axis, which is x-axis, it is the market required rate of return. It means that the bond price depend upon the market required rate of return, and we will discuss its relationship shortly. We have selected two types of bond with the maturity of 5 years and 15 years respectively. The green line is depicting a bond and its relationship with market required rate of return, bearing all factors into consideration, and its coupon rate is 10%. So at the bond, which has 5 years of maturity, has 10% stated coupon interest rate, and its par value is $1,000. Similarly, we have another risky investment or a bond opportunity to invest our money in. Its maturity is 15 years with same coupon rate, which is 10%, and its par value is once again the same as 5 years of maturity bond. So here we would like to develop certain relationship between the market required rate of return and the bond price by changing certain factors into the market. Let's discuss it one by one. So first of all, we would like to develop the relationship between bond price and the market required rate of return under the case of rising rates. What does it mean? It means that when the bank interest rate rise, like this is an independent variable, if the market required rate of return or the bank interest rate rise, like for example, previously it was 5%, and now if the government has changed subsequently the deposit rate or bank offer rate to the depositor and it has been risen, then the market required rate of return for a security will also rise. Like in order for the investors to invest their precious money into bond or common stock, when the bank interest rate will rise, definitely the other investment opportunity will have to perform in the similar fashion. Otherwise, most of the investor will directly invest their money into the bank deposit and can earn a secure interest rate. So when the bank interest rate rise, the condition states that the market required rate of return in all other investment opportunity normally rise. Therefore, the bond prices will fall. Let's discuss it, why the bond prices will react in such fashion. Assume that the required rate of return on a 15-year bond is 10% annual coupon paying bond, rises from 10% to 12%. Previously, the required rate of return was 10%. Now it has been risen to 12%. Then what does it have? What kind of impact it will have on this bond price? We can explain it with the help of graph. We got the same 15 years bond. with a stated coupon rate of 10% as mentioned in the condition. And the question states that when the market required rate of return jumps from 10% to the 12%, like this was the previous balancing point. However, the crossing or intersection point, if the market required rate of return increases from 10% to 12%, so it will intersect the 15 years maturity bond at this particular point. And we can see that the previously 1000 par bond price will reduce to certain extent because of this change into the market required rate of return. So we can infer that when the market required rate of return increases, the bond price will fall. With the help of valuation table and valuation formula, what we have discussed in the previous lectures, we can calculate its new price. So when the market required rate of return is increasing, the required rate of return on 15-year and its coupon rate was 10% annually, and it was paying bond 10% annual coupon paying bond has risen from 10 to 12%. So the market required rate of return has been increased by 2%. So therefore, the issuer of this bond will have to reduce its price so that to make this investment attractive to the investor and not to go for investing their money into the other available opportunities. So this is the major reason why the bond prices normally decline in order to respond to the increasing market required rate of return. Therefore, we can infer that the bond prices has fallen from $1,000 to $864. Like in previous slide, we can say that the previously $1,000 bond, which was having 15 years of maturity with the stated coupon rate of 10%, the price of this bond has been reduced to $864. How did we calculate this price? With the help of the bond valuation formula or with the help of table. You can simply plug this discount rate and then calculate the 10% coupon on 1000 face value, and you can simply plug the relevant values into the formula or with the help of present value interest factor for annuity table, and you can get the answer or value of this bond as $864. By plugging the data into the financial calculator, we can get a more precise answer for this bond price, which will be $863.78. I'll not waste my time on calculating the bond price. However, you can do it on your own because I have already explained the mechanism to calculate the bond value. Now let's discuss another situation which is having a declining rate into the market. So what does such kind of change in the market required rate of return will result into the prices of bond? So the condition states that when the interest rate fall into the market, that is known as a bank interest rate, then the market required rate of return also fall. It is a very normal condition that when the bank interest rate or deposit rate will fall, definitely it will lead towards the decline in the market required rate of return for different investment opportunities. And it will further lead towards the bond prices to change in a positive fashion. So we can say that when the bank interest rate fall, the market required rate of return by the investor normally fall, and it will lead towards an increase in the bond prices, which will be further endorsed with the help of mathematical example. Here is our example. Assume that the required rate of return on same 15 years of maturity 10% annual coupon paying bond falls from 10 to 8%. Now in this condition, the rest of the data is same. However, the market required rate of returns fall from 10 to 8%. And the case asks you to calculate or find out the impact of this change in the market required rate of return on the bond price. Let's see. With the help of graphical explanation, we can see in the pink color 15 years of bond. On the y-axis, bond price is mentioned. On x-axis, the market required rate of return is mentioned. It means that the change in the market required rate of return will leads to have a change into the bond prices either in positive or in negative fashion. As mentioned that this 10% coupon paying bond, which has previously the 10% market required rate of return, and it was paying the same coupon rate of 10%, then the price of this bond will be face value or par value, which is $1,000. However, if the market required rate of return falls from 10 to 8%, now what kind of impact this change will have on the bond price is the case under discussion. When the market required rate of return fall, we can see the dotted line and try to find out the intersection point. Here is the position where the market required rate of return intersect with the bond price, and we can see that this bond price will jump from $1,000 in upward direction. So our statement has been endorsed that when there is a decline in the market required rate of return, the bond prices will increase. It means that after this change, the bond will be selling on premium price. Let's discuss with the help of a numerical example. The required rate of return on 15-year 10% coupon paying bond has fallen from 10 to 8%. Then what will be its price? With the help of formula, you can simply calculate the coupon rate, which is the annual interest payment on this bond investment, by multiplying this 10% with the face value, and you will get $100 of coupon payment annually. Now this coupon payment will continue on for how many years? Definitely for 15 years. So you can plug this data into the formula and to use the discount rate of 8%, which is the market required rate of return. Therefore, you can find out the value of this bond under the declining rate condition, which state that the bond price has risen from $1,000 to $1,171. With more precision, you can use a financial calculator by simply plugging the relevant data into the financial calculator, or you can also use Excel. The more precise answer for this bond's price is $1,171.19. Now we can conclude that when the market required rate of return declines, it will lead a positive influence or positive impact on the bond prices. Therefore, the bond prices will jump from its par value of $1,000 and it will start selling out on premium price. Now let us discuss another condition to develop the nexus between the bond price and yield relationship. The second agenda is the role of bond maturity. Now we will have two bonds with the same risk nature, however with the different maturity time period. The condition states that the longer the bond maturity, the greater the change in bond prices for a given change in the market required rate of return. It means that when we will have a longer maturity bond and we change the market required rate of return from certain percentage to the another one, then the bond which has a greater or longer maturity time period, its price will highly be influenced in comparison to a short-term bond maturity, a short-term bond or its maturity which has a short-term or short time period. Let us take an example to discuss this condition. Assume that the required rate of return on both bond, the 5-year and 15 years 10% annual coupon paying bond fall from 10 to 8%. Now this is a declining rate condition having two different bonds with 5 years of maturity and 15 years of maturity. And the condition asks you that what will happen to the bond prices if we got this change in the market required rate of return. So let us discuss firstly with the help of a graph and then with numerical case. We have two bonds, one is with 5 years of maturity and another one is with 15 years of maturity with same risk factor. However, the bond price, the market required rate of return declines from 10 to 8%, and the condition asks us that which bond will perform or get influence greater than the other one. So we can see that the green graph, which is pertinent to the 5 years maturity graph, and its price will jump from 1000 to this point. However, the red graph, which is relevant to the 15 years of maturity bond, it will intersect at this particular point. So we can see that there will be a greater change in the bond price having greater number of maturity or time period with given change in the market required rate of return. So here the condition fulfills that if the maturity of a particular bond is greater, then its price will greatly be influenced if there is certain change in the market rate of return in comparison to a short-term bond. So with the help of formula, what we have done in previous lecture to calculate or to find out the value of the bond, we can infer that the required rate of return on both the 5 and 15 years bond is 10%. Annual coupon paying bond has fallen from 10 to 8%. This is our condition. The 5 years bond price has risen from 1000 to 1080 for 5 years bond. And if you would like to calculate or find out the percentage increase in its bond price, then the change in the bond price is 8% with 5 years of maturity. At the very same time, the other bond, which is having 15 years of time period or maturity, its price will rise from 1000 to 1171. And if we calculate the percentage increase in the bond price, it is 17.1%, which is twice as faster than the short-term maturity bond. As we can see that the increase in the price of 5 years maturity bond is 8%. However, the increase in the bond price of long-term maturity is 17.1%. And hence our condition has been fulfilled, which was stating that the longer the bond maturity, the greater the change in the bond price for a given change in the market required rate of return. And this narration has been proved graphically and as well as mathematically. Here we have the last condition, which is role of coupon rate. Now we will have another condition, and the narration states that For a given change in the market required rate of return, the bond price will change by proportionally more if there is lower the coupon rate. Now let's suppose we got the same example. Assume that the market required rate of return on two equally risky bonds, which is having 15 years of maturity, is 10%. We got two bonds with the same maturity time period of 15 years. They both are equally risky to invest their money in. However, there is a slight change in the condition that the annual coupon bond for bond H, which is referring towards high coupon rate, is 10%. However, the other bond which is depicted or referred as bond L for lower coupon rate is 8%. So if the coupon rate on two bond is different, however rest of the characteristics are same, then what kind of impact the change in the market rate of return will lead on the bond price? Therefore, the question asks us that what is the rate of change in each of the bond prices if the market required rate of returns fall to 8%. Previously, this market required rate of return was 10%, and now it has been fall to 8%. Then what will be impact, or what kind of impact will be there on the bond prices of these two equally risky bonds? So the bond price on bond H, which is having higher coupon rate, and L prior to change in the market rate was 1000 and 848 respectively. The price for bond H will rise from 1000 to 1171, which is 17.1% increase in its price. However, the bond price for bond L, which is having a lower coupon rate, which was 8%, will rise from 848 to $1,000, which is leading towards 17.9% change in the bond price. Therefore, we can conclude that, as mentioned in the narration of our condition, here it is that for a given change in the market required rate of return, the bond price will change by proportionally more if there is a lower coupon rate. So hence we have proved that when there is a lower coupon rate, bond will have a greater increase in its bond price in comparison to a similar nature bond having a larger coupon rate or a greater coupon rate. So this was all about the bond price and yield relationship under different situation and conditions of declining rate, of increasing rate, and the impact of coupon rate, and as well as the maturity time period. I hope you understand this lecture. Thank you very much for listening to this lecture. If you have any confusion, you are free to post your question on KCMS, or you can comment on this video lecture and I'll be happy to answer your question. Good luck for the day. Allah Hafiz.